Right. So getting a business off the ground,
Yeah.
that's exciting stuff. We're diving into financial intelligence for entrepreneurs today,
Okay.
which is packed with insights to help you navigate the financial side of things.
Right.
We'll break down these concepts in a way that makes sense,
Sure.
even if numbers aren't your usual jam.
What's interesting is that finance for entrepreneurs isn't just about the raw numbers.
Right.
It's about understanding the decisions and assumptions behind them.
Okay.
It's like detective work,
Yeah,
figuring out the story the numbers tell.
I like that.
For example,
Yeah.
the book points out that even something like depreciation
Okay.
isn't as straightforward as it might seem.
Depreciation.
Yeah.
That sounds like something straight out of an accounting textbook.
Right.
How does that apply to someone just starting out?
Think about it this way.
Okay.
Let's say you buy a delivery van for your business.
Okay.
That van's value will decrease over time, right? Depreciation is basically spreading the cost of that van over its useful life.
So it's not like I deduct the entire cost of the van in the year I buy it.
Exactly. You spread out the cost,
Right.
and how you spread it out can actually impact your profitability on paper.
Wow.
The book uses this fascinating example from the airline industry to illustrate this point.
Okay, I'm intrigued.
Yeah.
Tell me more about these high-flying financial maneuvers.
A while back,
Yeah.
airlines realized their planes were lasting longer than initially predicted,
Interesting.
so they adjusted their depreciation schedules,
Okay.
spreading the cost over a longer period.
Okay.
This simple accounting tweak made their annual expenses look smaller,
Right.
and voila,
Yeah.
their profits on paper soared even though their operations didn't actually change.
So it's like they found a way to make their numbers look better without actually selling more tickets.
Precisely.
Wow.
It highlights why understanding these accounting nuances is so important, especially for entrepreneurs who rely on financial information to make key decisions.
That makes total sense.
Yeah.
If I'm looking at my numbers,
Right.
I want to make sure I'm seeing the reality of my business,
Yes.
not some accounting magic trick.
Right.
So where do we even begin?
Well,
The book mentions these three major financial statements.
the big three are the income statement,
Okay.
the balance sheet,
Yeah.
and the cash flow statement.
Okay.
Each tells a different part of your business's financial story.
All right. Let's have them one by one.
Sure.
Where should we start?
Let's start with the income statement,
Okay.
sometimes called the profit and loss statement.
Got it.
It's a snapshot of your company's performance over a period of time.
So like a monthly report card for my business.
Exactly.
Okay.
It shows you how much you made in sales,
Uh-huh.
also known as revenue,
Right.
how much you spend on expenses,
Yeah.
and the all-important bottom line, whether you made a profit or a loss.
Okay. That sounds pretty straightforward.
It is in essence.
Revenue minus expenses equals profit.
Yes.
Got it.
But there are some key concepts within the income statement that are important to grasp,
Okay.
particularly the matching principle.
Matching principle. That sounds kind of technical.
It's simpler than it sounds.
Okay.
Imagine you run an online store
Okay.
and buy a bulk order of t-shirts in June.
All right.
You don't record the entire cost of those shirts in June's expenses.
Okay.
You match the cost to the revenue they generate.
Okay.
So as you sell each shirt,
Right.
you record a portion of the cost.
So every shirt sale reflects its true cost,
Precisely.
not just a random chunk of my expenses.
Exactly.
Okay.
This principle ensures your profit calculation is accurate
Gotcha.
and reflects the actual performance of your business.
That makes sense.
Good.
But the book also mentions something about revenue recognition being tricky.
Right.
Okay.
Revenue recognition is about when you actually record revenue.
Right.
It might seem straightforward, but there's room for manipulation.
Oh, really?
Imagine you have a software company that sells annual subscriptions.
Okay.
Do you record all the revenue up front,
Right.
or do you spread it out over the year as the service is provided?
So even though you've collected the money for the entire year up front,
Right.
you might choose to record the revenue gradually.
Yeah.
Why would you do that?
Well, recognizing a larger chunk of revenue up front might look good on paper and please investors in the short term,
Right.
but it might not reflect the true long-term profitability of those subscriptions.
So it's a bit of a balancing act between showing good numbers now
Yeah,
and being honest about the long-term picture.
precisely.
Okay.
Understanding revenue recognition helps you analyze financial reports critically and avoid being misled by accounting tricks.
Right.
Now, there's another component of the income statement that's important to grasp.
Okay.
The cost of goods sold, also known as COGS.
Okay. Break that down for me.
Sure.
What exactly is COGS?
COGS includes all the direct costs associated with producing your product or service.
Okay.
If you're selling T-shirts,
Yeah.
it would include the cost of the shirts themselves,
Right.
the printing costs,
Okay.
and maybe even the direct labor involved in producing them.
So it's basically everything that goes into making the product ready to sell.
Exactly.
Okay.
And like with revenue recognition,
Mhm.
there can be some wiggle room in how COGS is calculated.
Interesting.
The book shares this interesting story about a manufacturing company
Okay.
where the plant manager was under pressure to meet a specific profit target.
Oh, I think I remember this one.
You do?
He found a clever way to make his numbers look better.
Right. To boost his profit margin,
Okay.
he shifted some costs from COGS to operating expenses.
So even though it technically helped him hit his target,
Yeah,
it wasn't really an honest representation of his business's performance.
exactly.
Wow.
Understanding how COGS impacts profitability is crucial for making informed business decisions, from pricing your products to evaluating your overall operational efficiency.
This deep dive into the income statement is eye-opening.
Yeah,
It's clear there's more to it than just revenue minus expenses.
right.
What's next on our financial statement tour?
Let's move on to the balance sheet.
Okay.
Think of it as a snapshot of your business's financial health at a specific point in time.
So if the income statement is like a report card over time,
Yes,
the balance sheet is like a single frame picture.
that's a great way to put it.
Okay.
The balance sheet shows what your business owns,
All right.
which are called assets,
Okay.
what it owes,
Yeah.
which are liabilities,
Got it.
and what's left over for the owner,
Right.
which is equity.
Okay. So assets,
Yeah.
liabilities, and
Yeah.
equity,
Yeah.
how do these all fit together?
They're connected by a fundamental accounting equation:
Okay.
assets, liabilities, plus equity.
Got it.
This equation always holds true,
Okay.
ensuring the balance sheet is always balanced.
It's like a financial seesaw. It's
Right.
always striving for equilibrium.
Yeah.
But what exactly are assets in a business context?
Assets are things your business owns that have value.
Okay.
The most obvious one is cash, the lifeblood of any business.
Right.
Then you have things like accounts receivable,
Okay.
which is money customers owe you for products or services you've already delivered.
So it's like an IOU from your customers'
Exactly.
money that's coming your way,
Right.
but isn't in your bank account yet.
Exactly. Inventory,
Yeah.
if you sell physical goods,
Right.
represents the value of the products you have on hand waiting to be sold.
Okay.
And then you have larger, more long-term assets like property, plant, and equipment.
So that would include things like my office space,
Yeah.
my computer, my
Yeah.
delivery van,
Exactly.
all those
Yeah.
tools I need to run my business.
Precisely.
Okay.
These are all considered assets because
Mhm.
they contribute to your business's ability to generate revenue. Now, things get a bit more abstract when we talk about an asset called goodwill.
Goodwill.
Yeah.
That sounds more like something you'd find in a greeting card.
I know, right?
What does it have to do with business?
Goodwill comes into play when one business acquires another.
Okay.
Let's say you buy a competitor for $1 million,
Right.
but their tangible assets,
Yeah.
like equipment and inventory,
Uh-huh.
are only worth $800,000.
Okay.
The extra $200,000 is recorded as goodwill.
So it's like paying a premium for something intangible,
Exactly.
like their brand reputation or customer relationship.
Exactly. Goodwill represents the value of those intangible assets
Right.
that contribute to a business's earning potential but aren't easily quantifiable.
I see.
Yeah.
It's a recognizing that a business is worth more than just the sum of its parts.
Right.
But how do you accurately value something as fuzzy as goodwill?
That's the tricky part.
Yeah.
And it often involves estimations and judgments.
Okay.
It's another reminder that finance isn't always black and white. There's an element of subjectivity,
Yeah.
even in accounting.
Interesting.
And speaking of intangible assets,
Yeah.
there are others that can be challenging to value,
Okay.
like software patents or brand reputation.
These are all crucial assets for many businesses,
They are,
especially in the digital world.
right?
How do you put a price tag on something like brand recognition or a patent's future earning potential?
It's a complex process
Right.
that often involves forecasting future cash flows
Okay.
and discounting them back to their present value.
Wow.
It requires a deep understanding of the industry
Oh,
and the market
right.
and the specific assets potential for generating future revenue.
So it's a mix of financial modeling
Yeah.
and good old-fashioned business judging.
Precisely.
Okay.
The key takeaway here is that while intangible assets can be incredibly valuable,
Yeah.
understanding their true worth requires careful analysis
Right.
and a healthy dose of skepticism.
Got it. So we've covered assets, Which are what we own.
Right.
What about liabilities?
Okay.
Those are what we owe, right?
Exactly.
Ah,
Liabilities represent everything your business owes to others.
correct.
The most common one is accounts payable, the bills you need to pay for goods or services you've already received.
So like the invoices from my suppliers or
Yeah.
the utility bills from my office.
Precisely.
Got it.
Then you have debt,
Okay.
both short-term and long-term.
Okay.
Short-term debt might include credit card balances or short-term loans.
Right.
Long-term debt could include bank loans or mortgages.
And just like with assets,
Yeah.
accurately accounting for liabilities can involve judgment calls and estimations.
Right, absolutely.
Okay.
Think about accrued expenses,
Okay.
like wages you owe to employees but haven't paid yet.
Yeah.
Or prepaid expenses,
Mhm.
like insurance premiums you've paid in advance.
Right.
These can create timing differences between when cash goes out and when the expenses are officially recorded on the income statement.
So it's like a constant juggling act.
Yeah.
Keeping track of what's due now,
Right.
what's coming due later,
Yeah.
and what's already been paid.
Exactly.
Gotcha.
And this is where a solid understanding of the balance sheet comes in.
Oh.
It helps you manage all these moving pieces,
Right.
ensure you're not overextending yourself financially,
Yeah.
and make informed decisions about your business's financial structure.
Wow. The balance sheet is like a financial puzzle,
Right.
and each piece plays a crucial role.
Yeah.
But before we move on,
Sure.
you mentioned earlier that profit flows into equity.
Yeah.
Can you elaborate on that?
Absolutely.
Okay.
Profit, that magical number we all strive for,
Right.
doesn't just disappear.
Okay.
It increases the owner's equity in the business.
So even if I'm generating cash and paying my bills,
Yeah.
if I'm not making a profit,
Right.
my equity will shrink.
That's right. Profit fuels the growth of your business's value.
Really?
That's why it's crucial for entrepreneurs to understand the interconnectedness of all three financial statements.
Gotcha.
They tell a comprehensive story about your business's health and performance.
Well said.
Thanks.
All right, we've tackled the income statement
Yeah.
and the balance sheet.
Okay.
Now let's dive into the final member of the big three,
All right.
the cash flow statement.
Sounds good.
This one seems to be a favorite among seasoned investors like Warren Buffett.
He loves it.
What's so special about cash flow?
The cash flow statement tracks the actual movement of cash in and out of your business.
Okay.
And as the saying goes,
Yeah.
cash is king.
I've heard that phrase before.
Yeah.
But why is cash so important?
Oh.
Isn't profit the ultimate goal?
Profit is essential,
Right.
but a profitable company can still go bankrupt if it runs out of cash.
Wait, how is that possible?
Right.
If a company is making money,
Yeah.
shouldn't it have cash?
Not necessarily.
Okay.
The income statement is based on accrual accounting, which means revenue and expenses are recorded when they're earned or incurred,
Okay.
not necessarily when cash changes hands.
Right.
The book shares a rather stressful story
Yeah?
about a financial analyst
Okay.
who was scrambling to cover payroll
Oh, no.
because the company had maxed out its credit line,
Okay.
even though on paper
Yeah.
they were profitable.
So you could be making a profit and still find yourself in a cash crunch.
Exactly.
That's scary.
It is.
The cash flow statement helps you avoid those scary scenarios
For sure.
by tracking the actual flow of cash.
Yeah.
So it's like a financial GPS,
That's a great analogy.
guiding us through the ups and downs of our business's cash flow.
That's right.
Okay.
It breaks down cash flow into three main categories:
Right.
operations,
Right.
investing, and financing.
Okay, let's break those down.
Sure.
What's cash flow from operations?
Cash flow from operations comes from your core business activities.
Right.
Selling products or services.
Okay.
Collecting payments. Uh-huh.
And paying for expenses?
Okay.
It's the lifeblood of your business's day-to-day operations.
So it's the money that's constantly flowing in and out as we're running our business.
Exactly.
Okay.
Then you have cash flow from investing,
Okay.
which tracks cash related to buying or selling long-term assets, like equipment or property.
So if I buy a new delivery van for my business,
Yes.
that would be a cash outflow under investing activities.
Exactly.
Got it.
And if you sell an old piece of equipment,
Yeah.
that would be a cash inflow.
Okay, cool.
And what about cash flow from financing?
All right, what is that?
Cash flow from financing focuses on how you raise and repay capital.
Okay.
This includes taking out loans,
Yeah.
issuing stock,
Yeah.
paying dividends,
Yeah, okay.
or repurchasing shares.
So it's about how we fund our business and manage our debt and equity.
Precisely.
Right.
Understanding the different types of cash flow is crucial for making informed decisions about how to manage your business's finances effectively.
This is all incredibly insightful.
Yeah. But the book emphasizes that Profit and cash flow aren't the same.
That's right.
Why is that?
It comes back to that idea of accrual accounting.
Oh.
Remember how revenue is recorded when it's earned, even if the customer hasn't paid yet?
Right.
This creates a timing difference between profit and cash flow.
So I could have a lot of sales on my income statement,
Yeah,
but not actually have the cash in hand yet?
exactly.
Okay.
The same goes for expenses.
Yeah.
You might have expenses recorded on your income statement that you haven't actually paid yet.
Right.
And then you have capital expenditures,
Uh-huh.
those big ticket investments like buying a new building or a piece of equipment.
Those are big hits to our cash flow,
They are.
even though they don't show up as expenses on the income statement all at once.
Exactly.
Okay.
That's why it's crucial to keep an eye on both profit and cash flow
Right.
to get a complete picture of your business's financial health.
This has been an incredible deep dive into the world of the cash flow statement.
Yeah, it's fascinating.
It's clear that understanding cash flow is non-negotiable for any entrepreneur,
It really is,
especially those just starting out.
for sure.
But before we move on to other financial tools and strategies,
Yeah,
what's one key piece of advice you'd give a new entrepreneur
okay.
based on what we've discussed so far?
Focus on understanding the story your financial statements are telling you,
Okay.
not just the numbers themselves.
Right.
Don't be afraid to ask questions.
Okay.
Seek guidance
Gotcha.
and develop your financial literacy.
Right.
It's an investment that will pay dividends throughout your entrepreneurial journey.
I like that.
Good. Now that we've covered those core financial statements,
Okay.
let's move on to a powerful tool
All right.
that can help you analyze your business's performance.
Okay.
Ratio analysis.
Ratio analysis. That sounds a bit intimidating.
Yeah, it can sound that way.
Is this something a new entrepreneur really needs to worry about?
It's not as complicated as it might sound.
Yeah.
Think of ratios like financial fitness trackers for your business.
Okay. I like that analogy.
Good.
But what exactly do these ratios measure?
Okay.
And how can they help me make better decisions?
There are several key types of ratios,
Right.
each focusing on a different aspect of your business's financial health.
Okay.
Profitability,
Right.
leverage,
Right.
liquidity, and
Wait.
efficiency.
Okay. Let's unpack these one by one.
Sure.
What are profitability ratios all about?
Profitability ratios show how efficiently you're converting sales into profit.
Okay.
One of the most important ones is the gross profit margin.
Gross profit margin. That sounds familiar.
Yeah.
I think I've come across that term before.
It's a fundamental measure of profitability.
Right.
Think of it this way.
Okay.
You sell a product for $100
Uh-huh.
and it costs you $60 to produce.
Good.
Your gross profit is $40
Right.
and your gross profit margin is 40%.
So the gross profit margin tells me how much profit I'm making on each dollar of sales after covering my direct production costs.
Exactly.
Okay.
It's a key indicator of your pricing power
Yeah.
and your ability to control costs.
Makes sense.
Good.
If my gross profit margin is low,
Right.
it either means I'm not pricing my products high enough
Yeah,
or my production costs are too high.
precisely.
Okay.
Monitoring your gross profit margin over time can help you identify trends and potential red flags.
Right.
For example, if your gross margin is declining,
Okay.
it might signal increasing competition,
Mhm.
rising raw material costs,
Right. Yeah.
or even that you're discounting too heavily to maintain sales.
So it was like a canary in a coal mine,
I like that.
alerting me to potential problems early on.
That's a great way to put it.
Okay.
Now, beyond gross profit margin,
Mm-hmm.
there are other profitability ratios
Okay.
that provide valuable insights. Operating margin, for example, factors in all your operating expenses,
Right.
including things like rent, salaries, and
Yeah.
marketing,
Right.
in addition to your COGS.
So operating margin gives me a broader view of my profitability,
Yes.
taking into account all the costs associated with running my business, not just the direct costs of producing goods or services.
Exactly.
Okay.
It's a good indicator of how efficiently you and your management team are running the business overall.
Right.
A shrinking operating margin might indicate your costs are growing faster than your revenue,
Okay.
which is rarely a sustainable path to success.
So it's a metric that keeps me honest about my operational efficiency.
Precisely.
Yeah.
And then you have the net profit margin,
Oh.
which is the bottom line profitability metric.
Right.
It shows how much profit you keep for every dollar of sales after accounting for everything,
Right.
including taxes and interest.
So it's like the ultimate measure of how much value I'm creating for every dollar that comes through the door.
Exactly. It's important to remember that net profit margins can vary widely across industries.
Yeah.
Comparing your net margin to industry benchmarks can give you a sense of how you stack up against your competitors.
All right, so profitability ratios are all about understanding our margins
Yes.
and making sure we're pricing our products or services effectively.
Mm-hmm.
What about these leverage ratios?
Yeah.
What do they tell us?
Leverage ratios focus on debt.
Okay.
They help you understand how much debt you're using to finance your business
Right.
and whether that level of debt is healthy or putting you at risk.
Debt can be a double-edged sword, right?
Yes.
It can fuel growth,
Uh-huh.
but too much debt can cripple a business.
That's right.
What's the key leverage ratio I should be aware of?
The most common one is the debt-to-equity ratio.
Debt to equity ratio.
Yeah.
Yeah.
It compares your total debt to your shareholders' equity.
Okay. Break that down for me.
Sure.
What exactly is shareholders' equity?
Equity represents the owner's stake in the business. It's what's left over after you subtract your liabilities from your assets.
Got it.
It basically represents the value of the business that belongs to the owners.
So the debt to equity ratio tells me how much my business is financed by borrowed money versus money invested by me and other owners.
Exactly.
Right.
A high debt-to-equity ratio means you're relying heavily on debt to finance your operations.
Right.
While this might be acceptable in some situations,
Okay.
especially in industries with large upfront investments,
Right.
it also makes your business more vulnerable to economic downturns or interest rate hikes.
So it's about finding the right balance.
Exactly.
Just like with most things in business.
Precisely.
Okay.
Another leverage ratio to keep an eye on
Go.
is the times interest earned ratio,
Why?
also known as the interest coverage ratio.
Okay.
It tells you how easily you can cover your interest expenses
Right.
with your operating profit.
So it's like a measure of my financial cushion, ensuring I can comfortably handle my debt payments, even if profits dip a bit.
Exactly. A higher times interest earned ratio indicates a stronger financial position
Gotcha.
and a lower risk of defaulting on your debt obligations.
These leverage ratios definitely seem like essential tools for any entrepreneur using debt to finance their business.
They really are.
What about liquidity ratios? What do they measure?
Liquidity ratios focus on your short-term financial health.
Okay.
They assess your ability to meet your short-term obligations,
Right.
like paying your bills,
Right.
covering payroll,
Cool.
or repaying short-term loans.
So it's about making sure I have enough cash on hand to keep the lights on and the wheels turning.
Exactly. One of the key liquidity ratios is the current ratio.
Current ratio.
Yeah. It compares your current assets to your current liabilities.
Remind me again.
Sure.
What are current assets and current liabilities?
Current assets are things you can quickly convert to cash within a year,
Okay.
like cash itself, accounts receivable,
Right.
and inventory.
Okay.
Current liabilities are obligations due within a year,
Right.
like accounts payable
Okay.
and short-term debt.
Got it. So a higher current ratio means I have more than enough liquid assets to cover my short-term debts.
Yes,
Giving me a financial buffer.
exactly.
Oh.
It indicates a stronger short-term financial position
All right.
and a lower risk of running into cash flow problems.
But what if my current ratio is really high?
Okay.
Is that always a good thing?
Not necessarily.
All right.
An extremely high current ratio might indicate that you're sitting on too much cash,
All right.
which could be a sign of missed investment opportunities
All right.
or a lack of growth initiatives.
So it's like finding that sweet spot between having enough cash on hand to be safe,
yeah,
but not so much that I'm missing out on growth potential.
exactly.
Okay.
Now, another liquidity ratio to consider
Right.
is the quick ratio.
Quick ratio.
Also
Yeah.
known as the acid test ratio. It's similar to the current ratio,
Yeah.
but it excludes inventory from current assets.
Why exclude inventory?
Inventory can sometimes be slow to convert to cash,
Okay.
especially if you're in a business with seasonal demand or products that have a long shelf life.
Right.
The quick ratio provides a more conservative view of your liquidity,
Okay.
focusing on the assets that can be turned into cash most quickly.
So it's like assessing my ability to handle financial emergency,
Yeah,
assuming I might not be able to sell my inventory quickly.
precisely.
Okay.
The quick ratio is a valuable tool for entrepreneurs
Uh-huh.
who want to ensure they have enough readily available cash to weather any unexpected storms.
Liquidity ratios are definitely essential tools for any entrepreneur who wants to sleep well at night,
They are,
knowing they can handle their short-term financial obligations.
for sure.
Now let's move on to the last category of ratios.
Okay.
Efficiency ratios.
Right.
What are those all about?
Efficiency ratios are all about how effectively you're managing your assets and liabilities, particularly those related to your working capital cycle.
Working capital cycle.
Yeah.
Remind me what that is again.
It's the process of converting your inventory into cash.
Okay.
It starts with purchasing raw materials or finished goods,
Right.
then selling those goods to customers, and finally collecting payment.
Got it.
The more efficiently you manage this cycle,
Yeah.
the more cash you have available
Right.
to invest in growth or weather unexpected expenses.
So how do these efficiency ratios help us measure that efficiency?
Two key efficiency ratios we've already touched upon are days sales outstanding, or DSO,
Okay.
and days in inventory,
Right.
or DII.
Got it.
Remember,
Yeah.
DSO measures how long it takes,
Right.
on average, to collect payments from customers.
Right. And a high DSO is generally not a good sign, right?
It's not ideal.
It means our cash is tied up in unpaid invoices.
That's right.
But why is that a problem,
Okay.
besides just wanting to get paid quickly?
A high DSO can hinder your ability to reinvest profits,
Okay.
pursue growth opportunities, or
Wow.
even cover your operating expenses.
Yeah, that makes sense.
It's like having a leaky faucet in your cash flow system.
I see.
Yeah,
So it's not just about being impatient.
right.
It's about ensuring a healthy flow of cash
Hmm.
to keep the business running smoothly.
Exactly.
Okay.
And then you have DII,
Yeah.
which measures how long,
Yeah.
on average,
Uh-huh.
inventory sits on your shelves before being sold.
Right. And we talked earlier about how a high DII can be a sign of overstocking or slow-moving products.
Uh-huh.
But what are the real-world consequences of a high DII? Why is it something I should be actively trying to lower?
Holding on to inventory for long periods ties up valuable cash
Okay.
that could be used for other purposes.
Right.
It also increases the risk of obsolescence,
Yeah.
damage, or
Oh.
theft.
Right.
And let's not forget about storage costs.
So it's like having money sitting idle on a shelf,
That's a great way to think about it.
gathering dust instead of generating returns.
That's a great analogy. The book highlights that even small improvements in DII can free up significant cash flow.
Wow.
Imagine reducing your DII by just one day.
Okay.
If you have $1 million in inventory,
Hmm.
that one-day reduction frees up over $2,700 in cash
Wow.
that you can now use to invest in growth,
Yeah.
pay down debt,
Right.
or simply strengthen your financial position.
Wow. That's a powerful illustration of how optimizing efficiency can directly impact our bottom line.
It really is.
These efficiency ratios are like financial detectives,
Yeah.
helping us uncover hidden opportunities to improve our cash flow and overall business performance.
Exactly.
Right.
And remember, ratio analysis is not a one-time exercise.
Right.
It's an ongoing process.
Uh,
The real power comes from tracking these ratios over time,
Uh-huh.
identifying trends, and
Yeah.
using them to make informed decisions
There you go.
about pricing,
Uh-huh.
inventory management. Right.
Growth strategies.
Gotcha.
Yeah, more.
This deep dive into the world of ratios has been incredibly enlightening.
Yeah, they're really useful.
It's amazing how comparing seemingly simple numbers can unlock such a profound insights about our businesses.
It really is powerful.
And the key takeaway here is that you don't need to be a financial whiz to leverage the power of ratio analysis.
You don't.
With a little bit of financial intelligence
Right.
and a willingness to dig beneath the surface,
Exactly.
any entrepreneur can use these tools to make smarter decisions and steer their business towards success.
That's the goal. Well said.
Thanks.
Now we've covered the fundamentals of financial statements,
Right.
working capital management, and ratio analysis.
Yes.
What about the human side of financial intelligence?
Okay.
How do we create a company culture
Yeah.
where everyone is empowered to understand and contribute to the financial well-being of the business?
Building a financially intelligent company culture is paramount, especially for entrepreneurs.
Right.
When everyone understands the financial language,
Yeah.
it empowers them to make better decisions and contribute to the overall success of the business.
Okay.
It's like giving everyone a compass to navigate towards a shared destination.
I love that analogy.
Good.
But how do we actually create that culture?
Right. So,
One thing to understand the numbers ourselves,
right.
but how do we translate that knowledge to our teams?
It starts with leadership.
Okay.
As entrepreneurs,
Yeah.
we need to be financially literate ourselves.
Right.
And demonstrate a genuine interest in understanding and sharing financial information.
It's about walking the talk.
Yes.
Not just talking the talk.
Exactly.
Okay.
Lead by example.
All right.
Be open and transparent about the financial realities of the business.
Gotcha.
Celebrate financial wins together.
Right.
And when challenges arise,
Yeah.
address them head on with honesty and a commitment to finding solutions as a team.
That makes sense. But just sharing numbers can be overwhelming for those who aren't familiar with accounting jargon.
Right.
How do we make finance more accessible and engaging for our teams?
That's where open book management comes in.
Open book management.
Yeah. Instead of keeping financial information shrouded in secrecy,
Right.
open book management encourages sharing key financial data with employees,
Yep.
explaining what the numbers mean,
Yeah.
and involving them in setting financial goals
All right.
and tracking progress.
So it's like giving everyone a peek behind the curtain,
Exactly.
showing them how their individual efforts contribute to the big picture.
Precisely.
Yeah.
The book mentions several successful companies that practice open book management,
Okay.
and they've seen incredible results.
That's great.
Employees are more engaged,
Yeah.
more aligned,
Yeah.
and more committed to driving the company's success.
But wouldn't sharing sensitive financial information make us vulnerable?
It's a valid concern.
What if competitors get their hands on it?
While there are always risks associated with transparency,
Right.
the benefits far outweigh them.
No.
When employees understand the financial realities of the business,
Yeah.
they're more likely to make responsible decisions,
Right.
be more engaged in their work,
Mhm.
and contribute to the company's success.
That makes sense.
Good.
It's about building a culture of trust and mutual respect.
Exactly.
But even if we decide to embrace open book management,
Right.
how do we present financial information in a way that doesn't scare people away?
Okay.
Spreadsheets and financial statements can be pretty intimidating for those who aren't used to them.
That's where creativity comes in.
Okay.
Instead of bombarding your team with dry data,
Right.
use visuals,
Yeah.
analogies, and real-life examples
Gotcha.
to make finance more relatable and understandable.
The book mentions the use of money maps as a visual tool to illustrate how the company makes money and where each department's expenses fit into the overall picture.
Yeah, those can be helpful.
What are some other ways to make finance more engaging?
Think about using infographics, interactive dashboards,
Right.
or even gamified learning experiences
Yeah.
to make financial concepts more fun and accessible.
So it's about making finance less intimidating
Yeah,
and more like a game we can all play and win together.
exactly.
Yeah.
When you make finance fun and engaging,
Yeah.
people are more likely to embrace it and contribute their ideas and insights.
This is fantastic.
Okay.
What else can we do to nurture financial intelligence within our teams?
Encourage ongoing learning and development.
Okay.
Provide opportunities for employees to enhance their financial literacy through workshops, online courses, or even mentorship programs.
So it's about investing in our team's growth
Yes.
and empowering them to become financially savvy contributors to the business.
Precisely.
Right.
And as you build this culture of financial intelligence,
Yeah.
you'll find that your team becomes more engaged,
Uh-huh.
more aligned, and more committed to driving the success of the business.
This has been an incredible exploration of how to create a financially intelligent company culture.
It's powerful stuff.
It's clear that transparency,
Yeah.
education, and a shared understanding of the numbers can be a powerful force for growth and success.
It really is.
Now, let's talk about growth itself.
Okay.
Managing finances in a startup is one thing,
Right.
but navigating the financial complexities of growth is a whole other beast.
It is.
What are some key considerations entrepreneurs need to be aware of as their businesses start to scale?
Growth is exciting,
It is.
but it can also be a financial tightrope walk.
Right.
One of the first challenges entrepreneurs face
Yeah.
is figuring out how to finance that growth.
Okay.
Do you reinvest profits?
Right.
Seek outside investments?
Mhm.
Take on debt?
Yeah.
Or a combination of these?
Right.
Each option comes with its own set of risks and rewards.
It's like choosing the right fuel to power our growth engine. What are some key factors to consider when making these financing decisions?
First, understand your burn rate.
Burn rate.
Yeah.
Yeah. Okay.
This is the rate at which you're spending your cash reserves,
Okay.
typically measured on a monthly basis.
Right.
If you're not generating enough revenue to cover your expenses,
Right.
you're burning through cash.
Yeah.
And
What-
you need to know how long your runway is
Okay.
before you need to secure more funding.
So it's like having a financial fuel gauge,
But I like that.
alerting me when I need to refuel before I run out of gas.
Exactly.
Okay.
Knowing your burn rate helps you make informed decisions about how much funding you need to raise and when.
That makes sense.
Good.
What else should I be thinking about as my business starts to grow?
Cash flow management becomes even more critical as you scale.
All right.
You need to make sure you have enough cash on hand
Right.
to cover your expanding operations, manage inventory effectively,
Right.
and handle those inevitable bumps in the road that come with growth.
It's like making sure my financial plumbing can handle the increased flow of business.
Exactly.
Think
As
about it.
you grow,
Yeah.
you'll likely be dealing with larger orders, more
Mhm.
customers,
All right.
and potentially even new suppliers.
And managing accounts receivable becomes even more crucial as my customer base expands.
Absolutely.
Yeah.
You need to establish clear credit policies,
Right.
streamline your invoicing process,
Ah,
and be diligent about collecting payments
right.
to ensure a steady flow of cash.
Okay.
The last thing you want is to be drowning in revenue but starving for cash because you can't collect on your invoices.
That would be a frustrating situation to say the least.
It would.
The book also mentions that businesses go through different stages of growth
Mm-hmm.
and that each stage presents its unique financial challenges.
That's right.
Can you elaborate on that a bit?
As your business evolves,
Yeah.
your financial needs will change.
Okay.
You might start by bootstrapping,
Yeah.
relying on personal savings
Sure.
or small loans.
Okay.
Then as you gain traction,
Yeah.
you might seek angel investors or venture capital funding.
Right.
And eventually,
Yeah.
you might even consider going public through an IPO.
Wow.
Each stage requires a different financial strategy
All right.
and a deep understanding of the risks and opportunities involved.
It's like climbing a mountain.
Yeah, I like that.
Each stage presenting new challenges and
Yeah.
requiring different skills and equipment.
That's a great analogy.
I
As
bet-
entrepreneurs, we
Mhm.
need to be prepared to adapt our financial strategies
Right.
as we climb those different stages of growth,
Uh-huh.
always keeping a watchful eye on our cash flow,
Right.
managing our debt prudently, and
right.
making strategic investments that align with our long-term vision.
This has been an incredibly insightful exploration of the financial considerations associated with growing a business.
For sure.
It's clear that careful planning,
Yeah.
sound financial management,
Mm-hmm.
and a willingness to adapt are essential for navigating the path to sustainable growth.
Couldn't agree more.
But growth can take many forms, right?
It can.
It's not just about getting bigger.
Yeah.
It's also about expanding our reach,
Uh-huh.
adding new products or services,
Right.
or even acquiring other businesses.
Exactly.
What are some key financial considerations when evaluating these different growth strategies?
Each growth strategy comes with its own set of financial implications.
Okay.
For example,
Yeah.
expanding geographically requires a careful analysis of the new market,
Okay.
the costs of setting up operations,
Mhm.
and the potential impact on your working capital.
The book emphasizes the importance of developing robust financial models
It does.
to project revenues,
Yeah.
expenses,
Uh-huh.
and cash flows when considering these expansion plans.
Right.
What exactly does that entail?
Financial modeling
Yeah.
involves building a detailed spreadsheet
Right.
that simulates your business's financial performance under different scenarios. You'll need to gather data on market size,
Yep.
customer acquisition costs,
Right.
pricing, operating expenses,
Yeah.
and a host of other factors.
It sounds like a pretty involved process.
It can be.
Is this something I can do myself,
Well,
or do I need to hire a financial expert?
while there are certainly software tools and templates available to help you build financial models,
Okay.
it's often helpful to seek guidance from an experienced financial advisor,
Right.
especially if you're new to this.
Yeah.
They can help you avoid common pitfalls
Right.
and ensure your model is accurate and reliable.
That makes sense.
Good.
It's better to invest in expert advice up front than to make costly mistakes based on faulty assumptions.
I agree.
Now, when evaluating potential growth strategies,
Yeah.
it's not just about crunching numbers.
It's not.
You also need to consider the strategic fit
Right.
and the potential impact on your existing operations.
Mm-hmm.
Will expanding geographically dilute your resources
Good question.
or create logistical challenges?
Yeah.
Will adding a new product line cannibalize sales of your existing products?
That's something to consider.
It's about making sure the expansion aligns with your overall business goals
For sure.
and doesn't create more problems than it solves.
Exactly.
Okay.
Growth should enhance your business,
Right.
not jeopardize its long-term success.
What about acquisitions?
Okay.
What are some key financial considerations when evaluating the potential acquisition of another business?
Acquisitions can be a powerful way to accelerate growth. gain market share,
Right.
or acquire valuable technologies or talent.
Gotcha.
However,
Yeah.
they also come with significant financial complexities
Yeah.
and potential pitfalls.
Okay.
The book emphasizes the importance of conducting thorough due diligence.
Due diligence.
Yes,
Okay.
before acquiring a business,
Right.
carefully scrutinizing their financial statements,
Yeah.
customer base, and operations.
What does that entail?
Due diligence is like a financial health checkup for
Okay.
the business you're considering acquiring.
Right.
You'll want to examine their financial statements in detail,
Okay.
looking for any red flags, inconsistencies, or potential hidden liabilities.
Right.
You'll also want to assess their customer base,
Okay.
their competitive landscape,
Right.
and their overall operational efficiency.
So it's like doing a deep dive into their entire business
Exactly.
to make sure there are no surprises lurking beneath the surface.
Exactly. It's also crucial to evaluate the cultural fit
Right.
and ensure a smooth integration process post-acquisition.
Okay.
Acquisitions can be like a corporate marriage.
I love that analogy.
Be-
And you want to make sure it's a match made in heaven,
Right.
not a financial disaster waiting to happen.
Exactly.
It's a reminder that financial considerations are just one piece of the puzzle.
That's right.
We also need to consider the human element
Mhm.
and the potential cultural clashes that can arise when merging two businesses.
Absolutely.
Okay.
Successful acquisitions involve careful planning,
Right.
thorough analysis,
Uh-huh.
and a deep understanding of both the financial and the human dynamics at play.
This has been a fascinating exploration of the financial considerations involved in various growth strategies.
Yeah, they're all very different.
It's clear that each approach comes with its own set of challenges and rewards,
For sure.
and it's essential to make informed,
Yes.
data-driven decisions that align with our overall business goals.
Couldn't have said it better myself.
And the key takeaway here is that growth should be strategic and sustainable,
It should.
not just a race to get bigger.
Right.
By understanding the financial implications of our choices,
Yeah.
we can make sure that growth enhances our business,
Uh-huh.
not jeopardizes its long-term success.
I agree.
Well said. Now, throughout this deep dive,
Yeah.
we've been emphasizing that finance is not just about crunching numbers, but about understanding the story behind them.
Absolutely.
The book talks about the art of finance,
Right.
acknowledging that accounting involves judgments and estimates
Yes.
that can significantly impact a company's financial picture.
That's right.
Exactly.
Yeah.
It's like piecing together a puzzle
Yeah, I like that.
where the numbers are the pieces
Uh-huh.
and our financial intelligence helps us see the bigger picture.
That's a great way to put it.
We need to be aware of those subtle nuances,
Yes.
those assumptions and estimates,
Right.
and how they might shape the financial narrative.
Can you give me an example of how these judgments and estimates come into play?
Think about how we value intangible assets like goodwill or brand reputation.
Okay.
There's no precise formula.
No.
It involves a lot of educated guesswork and
Yeah.
subjective assessments.
That's right.
The same goes for things like depreciation.
Uh-huh.
The useful life of an asset is an estimate,
Right.
and different companies might use different methods to calculate depreciation.
So even though accounting seems like a very precise field,
Yeah,
there's still an element of subjectivity involved.
absolutely.
The book uses several examples like the airline industry adjusting depreciation schedules, or software companies manipulating revenue recognition to illustrate this point.
Yeah.
It's a reminder to be critical thinkers when analyzing financial reports.
Okay.
And not just take the numbers at face value.
So it's about combining our analytical skills with a healthy dose of skepticism.
Exactly.
Okay.
Always ask questions.
Right.
Seek clarification when needed.
Yeah.
Don't be afraid to dig beneath the surface and understand the assumptions and judgments that underpin the numbers.
This reminds me of that famous quote,
Oh, yeah.
"In God we trust. All others must bring data."
I like that.
But even with data,
Yeah,
we need to be discerning. Right.
absolutely.
As entrepreneurs,
Yes.
we need to be informed consumers of financial information,
Mm-hmm.
understanding the potential for bias or manipulation,
Right.
and seeking guidance when needed.
So it's about developing that critical thinking muscle,
Yeah.
that ability to see beyond the numbers and understand the story they're telling us.
Precisely. And as we enhance our financial intelligence,
Yeah.
we become better equipped to navigate the complex world of finance, make sound decisions,
Right.
and ultimately build businesses that are not only profitable,
Yeah.
but also sustainable and resilient.
I agree.
This has been an incredible deep dive into the world of financial intelligence for entrepreneurs.
It has been fun.
We've covered a lot of ground,
We have.
from understanding financial statements and ratios to mastering working capital management and creating a financially intelligent company culture.
Couldn't agree more.
But there's always more to learn, right?
Absolutely.
The pursuit of financial intelligence is a lifelong journey.
It is.
As your business grows and evolves, so too will your financial knowledge and skills.
That's the exciting part.
What are some final words of wisdom you'd offer to those embarking on this entrepreneurial adventure?
Embrace the challenges.
Okay.
Seek out knowledge.
Yeah.
And never underestimate the power of financial intelligence to transform your entrepreneurial dreams into a lasting reality.
I like that.
And remember,
Yeah.
you don't have to go it alone.
Right.
Surround yourself with a supportive network of advisors,
Okay.
mentors, and peers.
Right.
Seek out resources and educational opportunities.
Gotcha.
And never stop learning and growing, both as an entrepreneur and as a financially intelligent leader.
Thank you for joining us on this incredible deep dive into financial intelligence for entrepreneurs.
My pleasure.
We hope you found it insightful,
That's good.
empowering,
Yeah,
and maybe even a little bit fun.
a little bit.
Now go forth and conquer the world of business,
That's right.
armed with the financial wisdom to make smart decisions, navigate challenges,
Yeah.
and ultimately build a future that's both profitable and fulfilling.